Welcome to the Daily Brief. We'll go over the action in the market for Friday, January 13th, and then we'll see how things look for Tuesday, January 17th. Please be reminded that Monday, the markets will be closed in observance of Martin Luther King Jr. Day. So the next time the market will be open is on Tuesday. We had another up day, and it was really more positive than you might think. We weren't up all that much from close to close based on Thursday to Friday, but we gapped lower and pretty much set the low right at the open of the session, and then spent the rest of the day clawing our way back, got into positive territory, and ended up being up for the day. This helps not only our daily charts, but it's also helping our weekly charts, since they will then redraw a full bar for the week. We are getting into a bit of a short-term overbought condition. Even intermediate term, we're starting to look a little toppy right now, and we still have some pretty hefty overhead resistance. We're above the 200-day moving average, but can we stay above that? And then we have that down trend line that I'll show you. We still have that to break through and to try to close above that. So let's talk about what happened. Right at the open, we had a gap lower. The big news coming out were that banks were reporting earnings, and it was kind of a mixed picture. And a lot of them were really getting taken lower, and that's part of the reason we had the lower open. But as the day went on, things got better and better. The same thing is true with Tesla. It came out down right out of the gate, and it still finished down for the day, but it ended up recouping a lot of the losses during the session. So we did have a gap lower right at the open down to S1 at 39.48. That was the low for the day. And then we climbed back to the daily pivot, which was set at 39.73. As the day went on, prices moving above and below the daily pivot, and then we were able to climb back up to the unchanged level and then go above that. And then we remained positive, and we got all the way up to R1 at 40.33, and we closed just a little bit off of the high. So it was a fairly positive day. We were up 0.4%. We were on below average volume, so that's a little bit to be concerned about. We were right at about average, but then just a little bit below that. The technicals are turning a lot more positive now. We're seeing a lot of the positive backdrop. And I don't know why I have to keep clearing my throat. I never have to do this until I start recording. But I talk online all the time, but never have to clear my throat. I start recording and it happens all the time. Anyway, the technicals are looking a lot more positive. We are looking a little toppy. We still have overhead resistance, and we still have kind of a negative backdrop. And that's what the market likes sometimes. It's like, oh, the market's not going to go up. All these doom and gloomers have been pointing to the fact that the market's going to go down, and that may end up happening. But right now, we just have to go with what our charts are telling us, and we're seeing some improvement. And I do have some additional charts that I will show you. Here is the intraday chart where we gapped lower all the way down to S1, and that was the low. We came back up, filled the gap, and we chopped sideways above and below the daily pivot. We then broke above the daily pivot, and then this dashed line is the unchanged level. We broke above that, went into positive territory, and then saw some more strength going from there. We never did make it up to R1. We just closed a little bit below that and a little bit below the high. So what are some comments? We had a weak open and a strong close, and so that can be seen as positive. The earnings reports, they were mixed when they first came out, but most of them were positive by the time, in fact, I think all of them were positive by the time the market closed. The S&P is still above its 200-day simple moving average, which right now is at about 39.91. This redraws every day, so that's why we get a little different number. But we still have that downtrend line right above where we're at right now, and I'll show you that. The VIX to S&P 500 correlation, it's still declining, so that might be a valid spike that we're looking at after it was giving us that real extreme positive reading, which in our case would be negative. So you have to look at that counterintuitively. The dollar was down slightly and interest rates were up, and copper is still hanging in there pretty good. On a short-term basis, the usual suspects, if you've been watching the videos, the stochastics, the Stoch RSI, and the Williams percent are Those are still in extreme positive territory, and our list is getting a little longer in the intermediate term with the CCI 14, and I probably should have added the CCI 20 on here as well. The moving average study, the McClellan oscillator, and the CMB composite index. And I have charts of all these to show you. Long term, some of our moving average studies are getting a little bit toppy right now. We still have the 30 to the 5-year, which is no longer inverted. If it stays that way another day or so, I'll probably take this off the list. But the big ones, the 10-year to the 2-year and the 10-year to the 3-month, those still remain inverted. Sentiment has drifted over more in the positive side at 57. It's not extreme, so we can go with this for right now. When it gets up to 80 or above, that's when we really make a note of that and start looking in a contrary manner. We had import prices come out. They were up 0.4%. The last time they were down 0.7%. And if you take out oil, they were down 4%. So a lot of the strength came from oil prices. And the last time we had that report without including oil, it was down 0.3%. Export prices were down 2.6%. The last time they were down 0.4%. If you take out agricultural things, it was down 2.7%. And the last time it was down 0.7%. So we're seeing prices still continue to fall just a little bit. Consumer sentiment, this actually improved a little bit, even though 64.6 is not all that great. It was higher than the 60.5 that they had anticipated, and it's up from 59.7, and I have a chart of that. Our trend is still positive and strengthening. We're above the moving average, but we're still below 20. We have a positive bias and a positive momentum for right now. Here's the chart that I have been showing. The white line is just showing how the earnings per share has been coming down, and that's been adding a lot of overhead resistance to stocks and really preventing them from going higher. Then here's also the model looking back from 1998 through 2002, how the market has been sticking with that. But if we continue to go up, then we might break away from this basic price pattern. Here is the correlation between the VIX and the S&P 500, where we spiked up and we're starting to come down. This continues to fall, and we're continuing to go up. So this might be seen as a positive support for prices to go higher. That's kind of where we're at right now. That could change, but we can only look at what we see right now. The Ulcer Index continues to fall as we're getting more positive. This is also counterintuitive. When this goes up, that means there's more fear. When it goes down, that means there's less fear or more greed. The equity put call ratio actually ticked up slightly, possibly ahead of a 3-day weekend. People want to make sure that they're hedged, so they're buying more puts than calls. But when we look at the 5-day, it's still declining. And then longer term, after really spiking up and then coming down, we're down below this red line. So this also may be providing some support for prices to go higher. The VIX is still continuing to fall. We're well under 20 now, both with the line chart and on the bar chart. So this is suggesting that we're getting more complacent. Remember, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. If we really turn and start to go down, we would want to see the VIX come back up, because that means that there's more hedging going on within the S&P 500. And it's been acting kind of strange, which is why we've been focusing more on this ratio chart over here to still try to get some useful information from that. Then here is the consumer sentiment that came out. The blue line, that just shows how it's improved slightly in the preliminary reading. And then we compare that to the 2-year Treasury yield. These lines are still very far apart from each other, but interest rates have been coming down slightly with consumer sentiment going up, but the spread is still quite wide, where they have a tendency to move in the same direction. And even though they're on different scales, they have a tendency to go not very far apart from each other. The rate of change, I pulled that off of looking extreme just because we came up and now we've dropped back down. The same thing is true with the 10 period. We came up to an extreme reading and we've dropped back down from there. Here's our trend showing how the ADX is starting to turn up. It's above the moving average. The green line's on top, even though it declined. So we are looking more positive. As I usually say, if you're more aggressive, you like that right now, and you may have already jumped in based on what's happening. Those that are more conservative, you might want to see this go up further and possibly even get back above 20 before you're more convinced that we're in a trending environment. And I have basically two types of strategies that I use in broad terms. I have trending strategies and then non-trending strategies. And that's why I pay attention to this so much, because you can make money pretty much in any market environment. You just need to know what's happening at any given time, and that it can always switch from one environment to another. Here's our moving average study, still looking a little extreme with the 20, the 50, and showing improvement with the 200. The Stoke, again, this is a breakdown of the short term. Our stochastic study, extreme in the short term, extreme in the intermediate term, and looking better in the long short term. Stoke RSI, still extreme positive. Williams percent R, still extreme positive. The CCI 14, coming down a little bit, but still extreme. And here's the CCI 20, which I forgot to put on the list. Our oscillators have pretty much all switched over to positive now. The short term have turned up, the intermediate term oscillators and the longer term oscillators, they're all going in the same general direction, so that would be positive. The PMO, which we break down a little further to study, it's positive, and we're still advancing based on price and volume. Here's a PMO study that we do showing that those stocks inside the S&P 500, the percent of those that have a rising PMO, it came up extreme and has now dropped back slightly, but the number of buy signals, that's improving, and those PMOs that are above zero is also improving. The BPI continues to be above 50 and advancing, and it's not extreme, so that is positive. And then here's the long trend line that I've been talking about, where we bumped up at this level a couple of times, and it's really going to take some effort to get us through that and then to stay through that. And then this other horizontal line here, that's some more resistance that we could easily bump into. So we want to see if the market's ready to try to challenge that. It's already above the 200-day moving average, and that's positive. Now, can we get above this downward sloping trend line? The Swindling Trading Oscillator, based on price and volume, declined just a little bit, but they're still positive overall. And we're getting above the 200-day exponential and simple moving averages. And to close above that is positive, but we've done that before only to fall back down. Is this going to be another fake out where we get a little bit above this, the market freaks out, hits that overhead resistance, and then turns back down? Or are we going to be able to break through and keep going higher? We're looking a little more positive. So if I had to try to guess what I would think might happen with the positive backdrop that's developing, it does look like we might make a run to break through this resistance, but we're also becoming overbought in the short and even a little bit in the intermediate term. So it may not happen right away, and we might see some exhaustion before that happens. Here is the CMB composite index, where we're looking pretty toppy here. This is another reason why we may not be ready to tackle that trend line, at least yet. But this is positive overall, but giving us a pretty extreme reading. And if you look at other times when we got up to these similar levels, this often marked some either a slowdown in price movement, or if not, an actual reversal. And we're, for the first time since the beginning of December, we're just a little bit above the 200-day simple moving average. And I haven't shown this in a while. The Sean trend meter, it's starting to go into more really positive territory. We've been more in the neutral area, but now we're starting to come back into this other shaded area that's looking more positive. Here's the TTM squeeze. After showing a lot of improvement, it has now switched back over to positive. This is another trading system that folks use. McClellan oscillator, even though it declined a little bit, it's still rather extreme, but it is coming down and it is positive. The Bollinger Band still, we're starting to go outside of the upper Bollinger Band with the percent B indicator. So that's just suggesting that we might be overbought. New highs, new lows continue to show some improvement, but we rolled over just a little bit. Even though we are going up, we didn't see a real breakout in the new high. So that's a little bit of a warning sign. But the 5 period is still going up, even though it turned down slightly, and the 10 period is still going higher. The advanced decline line, we're showing a nice little breakout based on price. And now that we kind of left this in the dust, I drew some lines here, and it just shows where we were going sideways through a lot of December, from November into December. We were making a series of higher lows and higher highs with the advanced decline line based on price. We weren't doing that based on volume, but the volume is improving, and we've been able to cross back above the moving average. So this should be taken as more positive. Advanced decline ratio, also advancing and not extreme. Accumulation distribution, also advancing and above moving average that is trying to turn back up. And then our stochastics, we still have this overhead resistance here at about the 40-20 level. And we're looking a little toppy with the longer term moving average study with the 50, 150, and we rolled over just a little bit with the 200. So there are some warning signs. There's some signs of exhaustion that are starting to come into the market, that even on an up day, to see things like this roll over a little bit, we just want to be aware of those things. This is one I haven't shown in a long time. It's the special K. It's still negative, but you see how it's starting to turn up, and it takes a long time for this thing to really turn. We're still below a declining moving average, but we came down to a level that we set back in October, and we're starting to turn back up. If this can really start to go back up and cross the moving average, that would be more positive in the long term. And then I've been showing this. This is looking at the home builders. And again, go back and watch the video for Thursday's session to see more of an explanation of this. I'm really just going to talk about what's happening way over on the right side. And this is positive, where we're seeing a positive divergence as we're going higher with the S&P. The home builders ETF, it's also advancing. The ratio between the two shows that home builders are outperforming the S&P, so that's positive. And we're showing the correlation as they're tending to go more in the same overall direction. So right now, this chart is looking positive. It's not giving us any real negative divergences, even though we're seeing some weakness in some other areas. Point and figure, put in a new green X, and we're working off of a low pull reversal right now. So this is still positive overall and looking a little better. And in the deep dive video that I'll do over the weekend, I'll show you the 3-line break, the KG, the Renko, a lot of different charts which are showing improvement. I haven't included them here, but I will go over them in that deeper dive video. Copper still continuing to go up. We want to see, is this really the start of something? We haven't really crossed over positive yet to see a golden cross, but the blue line is starting to come back up to the red line. That could be signs that the economy might look better into the future. And a lot of this that we're seeing with copper going up and gold going up, I have a chart to show you, a lot of the commodities going up, that might have something to do because the dollar has been going down. And it's now into a death cross on the daily chart, and it's still in a death cross on the weekly chart. This is now a complete week, and you can see how we've really switched over to a downtrend. And that could be giving support to commodities as well as stocks. Another thing I haven't shown in a while is emerging markets. If you look at markets outside of the US, which is where a lot of investors like to diversify their money, we're seeing some real improvement here in getting ready to what could be a golden cross. Here's gold. It is giving us a golden cross right now. It's been performing a lot better, at least on a trend basis. Can that continue? And then I haven't talked about these in a long time because our possible positive scenarios, they really haven't been doing all that much. Well, we're starting to see some improvement. Here is the 19-day exponential moving average of the advanced decline line. We're really going up based on price, but we're not really working off an extreme negative reading. We had one a while back, but then things fizzled out. Where I wanted to show you is that we're starting to get a little extreme when we look at this based on volume. It went a little more extreme negative, and now it's going a little bit more extreme positive. So this could support some short-term exhaustion. Then the ratio between the Qs, which are growth, and the S&P, they've been really underperforming. This has been quite disappointing throughout 2022, but we are starting to see some improvement with the Qs. Discretionary is starting to show some improvement, and large cap growth compared to large cap value, it's still underneath the moving average, and it was flat on Friday, but it is showing some improvement. Here's another chart, which I'm taking back 2 years now, where it started with the large, mid, and small caps, like they were really starting to outperform the value areas, but then they really started to decline. Well, we're seeing some improvement here as well. And then I haven't shown this chart in a while. This is the 2-year yield compared to the S&P 500. And a lot of times when this comes up and spikes on a shorter term basis and then starts to come down, that provides some support for the S&P, usually in the short to maybe intermediate term. So we're just watching that to see, is the 2-year yield going to continue to decline, which may help stocks go up. Small cap index starting to give us a golden cross here. It came up above R1 and had a pretty good update. It was up 0.56%. And then here's the ratio where both the S&P and small caps are going up right now, but small caps are outperforming the S&P 500. And then here's another ratio where we have the red line. When this starts to really spike up and go, the blue line is the S&P, and sometimes this gives some support for the S&P to go higher. And we're starting to see that now. So that's looking more positive. And then the staples to the S&P, the ratio continues to drop. So this looks like it might be a valid signal. And so the S&P might get some more support going up. And again, if you look at other times when we spiked and we're hitting a bottom in the S&P, we saw a really nice run up after that, but we don't really know. We've been at this place multiple times in 2022 to see this really decline, only to have it fizzle out. So we want to be cautious of this one. So then our outlook for Tuesday, the markets will be closed on Monday, as I stated earlier. And I really haven't changed my overall picture where we're turning more positive, but we need to see more follow through buying. But we still have overhead resistance, and we're becoming more short-term overbought as well as intermediate-term overbought. On Tuesday, we only have the Empire State Manufacturing coming out. That applies more to New York, but that's a real important area. So we'll be paying attention to that. And then the list of geopolitical events, unless something happens over the weekend with Russia, Ukraine, really the markets are fixated on the inflation interest rate scenario overall, and the earnings that'll be coming out, as well as, are we in a recession? Will it turn into stagflation? That seems to be a little less likely now because inflation's been coming down. And deflation, well, we're seeing commodities start to show some improvement. So that may not be as prevalent as what people were saying a month or so ago. Then looking at the Stock Traders Almanac statistics for January 17th, not a really good day. The Dow is only up 52.4% of the time, but the S&P is also up 52.4% of the time. So we're neutral to slightly positive. The negative one is the NASDAQ. It's down, or it's only up 38.1% of the time. So that's more negative than positive. So we might see some headwinds if we stick to historical statistics for the session on Tuesday. And then none of this has changed if you've been watching this, where if you take all the Januaries for the last 20 years, they've been up 43% of the time, but down 56.5% of the time. We're still in the November, December, January, which tend to be the best 3-month span. Yearly, we're waiting until the end of January to see what the January barometer says, whether it's up or down. And then the market still likes that we have a Democratic president, and even Congress is split between Republican and Democrat. So that's why I'm going through this kind of quickly, because I'd be just saying the same things every day. Our scenarios can't go with the down scenario right now because we're looking a little bit more positive, unless you want to focus more on the fact that we're short-term overbought and a little bit intermediate term, and that we have some resistance. You'll want to, if you're able to watch the market during the day, if we do go higher and we start to hit that trend line, what is happening? Are we going to break through and get above that trend line? Or are we going to go up and hit that trend line and come back down if we even get to that point? We are looking more positive, but we're still not trending overall. but the scenarios, our rotation, our setups, they're looking better. And what I didn't cover in this video, I will cover in the deep dive video, because we're still maintaining our current prices above pivot levels. We've regained those. We're above the 200-day moving average. We still have some fib retracements above current prices, but we've been able to get above some other fib retracement levels. So we're still on a official basis, we're still in a sideways or neutral type of an environment, because the ADX, even though it's strengthening, it's still below 20, but it is positive. So our conclusion, the S&P is still could be in the phase of turning positive. Short-term positive, but overbought. Intermediate term positive, but becoming overbought. Long-term, I've actually switched this over to positive because we're above the 200-day simple moving average. And the longer we can stay above that, the longer our charts, our long-term charts, there are going to show some improvement. So thank you. Have a wonderful weekend. Enjoy the 3 days. If you get all 3 days off, I will prepare the weekly video and the intermarket analysis video, as well as the deep dive video over the weekend.